Michael Kurtz, Chief Asia Equity Strategist at Nomura. He joins us now to talk about Nomuras India outlook. Michael, fantastic to have you back, and thank you for joining us. Michael, the Indian government has announced easing of FDI caps in some key sectors yesterday. Do you think this move will help attracting more dollars?
Well, I wouldn't say the move comes too late, but it will be months. In fact, it will probably be 2014 before we really start to see any practical effect in terms of longer-term capital inflows into India. The move, though, could have some positive sentiment impact in terms of helping to put some sort of a backstop beneath what have been otherwise some pretty substantial portfolio outflows from India over the past month and a half or so.
So analysts do believe that the easing of FDI caps for telecom sector to 100% can attract a lot of investments. What's your view on the Indian telecom space right now?
Well, our telco analyst, Sachin Gupta, is not particularly enamored of Indian telcos. His main issue is simply that the Indian telcos generate extremely weak return on invested capital. In fact, below their cost of capital, which makes them basically value destroyers. The best that we can muster are neutral recommendations on some of the Indian telcos like Bharti, which we think is the best of a mediocre lot, and Reliance Communications. But for example, we've got a reduced recommendation on IDEA.
Right, Michael, in your recent note, you've made an interesting observation that prospects of eventual Fed tightening has historically led to non-US developed equities outperforming and the US in months prior and post-Fed tightening. So do record highs for Dow and S&P indicate that there is a threat of withdrawal from Mr. Bernanke?
Well, as a matter of fact, you could make the case that QE at this point, in terms of the tapering of QE, is already largely priced into expectations. One of the best, I think, examples of that is the fact that on many of the days over the past 2 to 3 weeks, when you've seen strong U.S. economic data released, you've seen U.S. equities do very well on those days. In other words, strong data does not equal bad news from the standpoint of the prospect for further or earlier tapering of U.S. Quantitative easing, but rather the markets are treating the strong data as good news from the standpoint of what it means for growth. If QE had not yet been fully priced in, it would be more likely that good economic data would be bad for stocks in terms of the outlook for the eventual tightening of policy.
Michael, the currency depreciation has turned out to be the bugbear for emerging market investments. So while equities have fallen behind in absolute returns, coupled with currency translation, it's making FIIs quite wary. What's your sense on that?
Yeah, this is exactly the issue with the strong dollar, is that for the developed markets of the world, Japan, Europe, a little bit of local currency weakness could be regarded as a good thing for both exports and for domestic reflation. But in the emerging market world, unfortunately, a weak local currency is simply regarded as a risk factor, as volatility, which investors choose to avoid or to reduce their exposure to. So we have this situation now where increasingly the strong dollar is less of a reason to be involved in the emerging markets, but still a relatively decent reason for investors to be exposed to the other developed markets outside the U.S. And it's largely for this exact reason that we are now more cautious on the emerging market asset class in the equity space. We've gone to formally underweight the EEMEA, basically Eastern Europe, and we have been underweight in Latin America for some time. So that leaves Asia, and really only parts of emerging Asia, as overweights for us within the emerging market equity space.
Michael, India also seems to be in a trouble spot. The finance minister recently said that all efforts are being made to achieve 6% growth for FY14, but given the pressure on currency and elevated levels on retail and wholesale inflation and a clear slowdown in industrial growth, are you likely to hunker down your projections for FY14 and then FY15?
We are a bit concerned about downside risks in India, specifically as a result of the recent RBI moves to try to put some support underneath the rupee. It's, of course, very important that Indian policymakers prevent any sort of greater run on the rupee and therefore some sort of a tightening of domestic liquidity was probably necessary. Unfortunately, that is likely to have the impact of raising interest rates even on the real sector and potentially then creating some downside risks for our growth forecast. In the current fiscal year, we're looking for 5.6% Indian GDP. Unfortunately, we now believe there may be some downside risks to our numbers, which themselves are below the consensus for 5.9.
So what is the investing scene right now for India? Which sectors are you long on, and what's it that you're avoiding?
Well, in light of recent policy announcements in India, we're in the process of reconsidering and revising our Indian equity recommendations. I think at the moment we would have to say at the very least that plays in the more interest rate sensitive domestic sectors, automobiles and property, for example, are going to be stocks that we would be looking to stay away from. In the banks space, where we were generally more willing to take exposure, at this point I would say smaller banks, which have more direct exposure to a rise in funding costs in the short-term interbank market, or the state-owned banks, where you have arguably more of an issue in terms of potential asset quality deterioration, are also sectors that we'd be looking to stay away from and focusing only on the more private sector banks in particular, larger private sector banks. Otherwise, it's really more of a defensive or low beta approach for us right now in India in light of our concerns about the potential growth dampening effect of the RBI's liquidity tightening.